Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, December 3rd, 2018. All right, let's take a look at the markets, what happened today, what we might expect going forward this week, and I want to do a comparison, take a look at the markets, the recent market action, and compare this with what we saw back around this time of the year in 2007. There's some interesting similarities to point out. So starting out with what happened today, here's SPY, a daily chart. We closed up 1.3% and just shy of this pretty significant level here around 281, a little north of 281. I have it at 281.16 here. And again, I've covered this in recent videos. What stands out to me is you have a series here of the previous two highs where we failed on the kickback rallies on SPY. That was also support right here, was resistance until taken out. So resistance back there, then support. We had a failure there and a brief pop there. So either way, it's a level to watch. Um, as I mentioned recently, with the gap up today, I think I did, yeah, in the video last night covering the futures, I mentioned that we were poised to gap above both the 250. I'm going to talk on this in a bit when we do the comparison 2007. As I said, with volatility being high, it's more than usual to see pretty important support levels to be crossed above and below, especially these EMAs, or you can use a simple moving average or an exponential, like these 50 and 200-day exponential moving averages here. So that's what we saw today. So you have to, at least in the near term, give a check mark to the bulls because they popped it back above those key levels. Um, and I'll just tell you straight up, my very near term, outlook on the market, it's neutral. I'm fielding a ton of questions in the trading room. By all means, I welcome those questions. But I'm seeing a lot of people that want to short XYZ or go long ABC, here or there. My best guess is this week will probably be frustrating for both longs and shorts. We've come up quite a bit. Let me just tell you in a nutshell, we're pretty overbought near term. Now, not on the daily chart, not on the daily RSI, but we've had a very extended move off the bottom. And again, this is just SPY. QQQ is even more volatile. There's about a 7% nearly vertical rally right here, and we could certainly go more. But as I mentioned, we have a lot of overhead resistance, some key levels at 281.16ish level. We have the primary bull market uptrend line not too far above, so a lot of work to be done to the upside. So while I think that the near-term risk reward, it's no longer very favorable. Or really on the long side at this point, I see, anything is possible, but I think the upside from here, and I'm talking the next 5 to 8%, will be limited. But yet we don't have anything remotely close to a sell signal in shorts. There's quite a few people, and although I think that we go down and take out these lows going forward, I just don't know if it's going to happen in December. We could trade sideways all month. So I just wanted to kind of get that out there. And if there's one thing I can pass along over the years, I've learned, after very profitable run the last few months, at least for me personally, I've been very profitable trading both long and short. When the charts aren't clear, stand aside. I've always said this. I've never had problems, even early on as a rookie trader. I've, never had problems making money in the markets. The hardest part was holding on to those gains and not giving them back after a big winning streak when your confidence is high, your position sizes go up, and then you start forcing trades or you think you have the magic touch. So all I'm trying to say is, if the charts aren't that clear to you, if you have to ask yourself, should I be long or short? Um, and then the question is, or the answer is, you probably should be neither. You probably should be in cash. Um, so again, there's a cross current of technical developments. I could sit here and talk about them all day. Very near term, the fact we had that powerful gap up today. Nobody can argue the very near term trend. I'm talking, since the lows back here in November 23rd. Nobody can argue that the near term trend isn't bullish. It clearly is. But again, it was very bullish here. It was very bullish here. So we can continue to go up, but again, the risk reward, there's too much resistance overhead. We're too overbought in the near term, but yet I don't see a solid case to short at this point in time. We did short. I believe we nailed the top of that last rip up, put it on this official trade on QQQ. At this point in time, I'd just like to see what happens here in the next few days. So there it is. Take it for what it's worth, and let's look at QQQ. Again, let's focus on some of these levels. I have a few more levels marked up on this QQQ daily chart. By levels, I'm referring to, of course, any line below current prices will be support, any line above is resistance. So on QQQ, just like SPY, we gapped up above the pinching 250-day exponential moving averages today. So at least from that aspect, that you have to give that check mark to the bulls there. We faded some of the gains earlier, but we still closed a nice, respectable, 1.75% gain in QQQ today. And you can also see that we closed above this 172.11-ish former resistance, now support level. And I do have different levels on the 60-minute charts. I'll try to get to those in a second here. But the next, on the daily chart, the next significant resistance level I see coming into play is 175.58. So on both QQQ and SPY, I can see a little more upside, although I favor a backfill of today's gaps. I'll get to that in a second on the 60-minute chart. And there's still plenty of upside if QQQ does want to make another back test of the trend line. Again, it already made a back test here, but has plenty of room if it wants to make another one. And then let's not forget that we put in recently a divergent low right here on QQQ, and this was, although it's not as diversified as the S&P 500, it has been the leading index. This market, the bull market from the day it began back in March 2009, it has been all about the FANG stocks: Facebook, Amazon, Alphabet, Microsoft. Not only, not that they're the largest gainers in the stock market over that period of time. There's always going to be smaller companies with higher growth rates, but they are by far the heaviest top-weighted components of the Nasdaq 100, and most of those also in the SPY top-weighted components as well. And so, if nothing else, that gives me pause as well, as far as just how far, and more importantly, how long this rise can go. And just to put this another way, the market's going to do one of three things, and we all know this. It's either going to go from here, it's going to go up or down. That's what most people think, or it can also go sideways. And that's one of the concern I have as well. Is and I'll box in the range that I could see it trading, and right about here, from that 175.58 down to about 169.39. Wouldn't surprise me to see us trade there the rest of the year. We're only in the beginning of December. Now, you talk about frustrating, and this is reflective of the lack of the trade ideas on the site. I see certain stocks. It was Tesla. Somebody asked me today. I was, been watching Tesla to get up to, what was it, 161. Let me pull another. Well, I'll not get off topic now. And some other things, but so there's some potential shorting ops because a lot of stocks are bouncing back to resistance levels where I was considering, but I don't want to swim against the tide. In other words, if the market continues to rise, or if it trades sideways, you're going to have a very hard time on shorts. Obviously, if it trades sideways, you're going to have a long time on long trades as well, particularly those trades that are heavily indexed in the QQQ or SPY. If a stock is a component of the index, it'll have buying and selling pressure relative to index going up and down. So that's another reason. Again, you want to align your trades with the trend in the market, especially if those stocks are correlated with the major indexes. And even if it's a small cap stock you're trading, is it a component of IWM or the Russell 2000? If so, you want to make sure you're going to have a much better success rate on that trade if you can align a long or short trade on that stock with a bullish or bearish case on IWM or the Russell 2000. Okay, and a quick look at the 60-minute charts. And this is pretty busy. I have a lot of lines. They're all, I think potential resistance levels. The ones that are right here, I have those a little brighter color. Those are nearby levels I'm watching. Pretty much this range right here. And again, I could see us bounce within that range. What I think we'll get soon, and I mentioned this I believe last night, is we'll get a pullback probably to this trend line, test this trend line, and that may continue to prove a buying op for longs if you get pullbacks to this trend line, at least for some time until we have some clear divergences or some type of sell signal. Or obviously, break of that trend line in itself may be a sell signal, but we don't really have negative divergence. We almost have divergence there on the PPO, but we don't. We have some on the RSI. So this could break. And if it does, I favor at this point in time a pullback only at about this 168.70 level. So put it in percentage terms from where we're at today. If we do pull back there, maybe even stop around 169.50. But at most, I'm looking at about a 2% downside. And then if I move this measuring tool up here, almost a 2% upside to that 175.52 level. And again, I right now, and this could change tomorrow, guys, if something big happens, but right now, I think I'm leaning towards a leaning towards some, grinding sideways action here for maybe this week. All right, so there's levels to watch. Again, I do think, it's hard to really say with conviction that we're going to go there tomorrow or very soon, but I think we'll backfill this gap here. But we may want to pop up first and hit that 175.52 level before we do so. So what I'm giving you is uncertainty. That's what I'm trying to tell you is where the very near-term direction of the market is. And we're going to get to the long-term stuff here in just a second. Just wrap it up on the 60-minute chart, at least with SPY. I think that's a pretty significant level, this 281 level right here. There's a line, and I'm going to get to this in a second when I compare the 2007 top to what's happened recently. But that's so far. This is where the party really kicked off back in October, the impulsive selling. We took out that level, and every attempt that we've had so far has failed. Now, usually when you get this close to a pretty well-watched level, you're going to hit it. You're either going to go up and test it, maybe pop through it. If we do pop through it, I would just based on everything that I'm seeing in the charts, I wouldn't chase that breakout long. In fact, I would put good odds that it would be a false breakout or a stop clearing raid, pop above there and then reverse. So keep an eye on that. You may have an objective shorting up here for a pullback trade. If you get above there, maybe you can even short at 281 with a stop a little bit above. Depends again what you're targeting, but that also plays into my lack of the official trade ideas. If the downside's minimal, if you're targeting 2-3% downside, well, if you want to keep a proper risk reward ratio there, 3% profit target shouldn't have much more than a 1% stop. Otherwise, you're just trading, equal odds, and that's, sometimes I'll do that, but overall, you want at least a 3-to-1 risk reward ratio on a trade. Risk 1 unit of loss for $3 of profit. Okay, now let's just take a look at what's happened. Let's just take a look at what's happened this year so far in 2018. Most of you are probably aware we had a tremendous run in 2017. It was an unprecedented period of low volatility where the market just went up and up and up, grinded up with very low volatility, never seen before. Levels on the VIX, extreme low volatility. And then that all ended with a bang early in January that culminated with this blow off type top, very sharp advance, and then a sharp correction. So basically, and this is, I think I said it back at the time, that this, seemed to me like a shot across the bow. And I'll get to that in a second. A shot across the bow. I think most of you know what that term means. The markets did hold support. They held the 200-day moving average. They touched and made perfect tests of their long-term trend lines. I don't have it on this chart, but we tested the bull market trend lines at those lows, and then the advance resumed. And we went on to put in and at the time I had mentioned that as a possible scenario, we went on to put in a divergent high afterwards. So market just basically pushed up, took a good part of the year, and then put in a big divergent high, and that divergence showed through on the weekly chart, and then this happened. So here's the selling in October, and in that sell-off, we've had a couple waves down. This initial wave down, I'm measuring the measuring tool here about 7%, a little kickback rally, but if you count it down to the lows, that was about 11%, maybe a little better from the highs. Yeah, about 12%. And then we had a nice sharp kickback rally here, about 8%, another leg down. So we all know this. It's been volatile. Now, these are very profitable to trade trends. And if I thought we were coming up on another one of these right now, and we may very soon, that's what I'd try to get in. So these are the trends so far that we've had, and I'm talking about short-term trends. And I also mentioned recently that we had positive divergence in the Nasdaq 100 (QQQ), which again has been the leading index, but we didn't have it in SPY, the S&P 500, the small caps, the Dow Jones Industrials, mid caps. However, they all look very similar. You had effectively a double bottom low. They all made a lower low, all those other indices on that initial thrust down here, and I think that was late October. But there's just a little spike there, intraday spike. And for the most part, that's where trading normalized here about at this line. So again, I've said this before, for all intents and purposes, that's a double bottom low right there in the S&P. And you had, if you exclude that little spike, then you did have nice bullish divergence. You could see the indicators making higher highs here. higher lows on both the PPO and the RSI. So that happened. That's where we're at right now. Actually, interesting to note, there's a nice doji candlestick there. Look, we had a doji there last time right around this level. So we'll see if there's some downside tomorrow. That may give us a potential sell signal, but we had a doji there, and but it wasn't confirmed. You had a green candle afterwards. If we get a big red candle tomorrow, a gap down, that would give us a potential. There's a myriad of possibilities here, but a gap down would give us a island cluster top. Let me try to grab the right tool here and give you this one here. You'd have to see something like this, a candlestick that left that one behind. Would actually have to come down a little lower than that. So that's just one of many possibilities. I'm getting off topic here. That's not what I wanted to cover, but this does speak to the fact that my analysis is dynamic. The markets are dynamic, and so is my analysis. So if something changed tomorrow, I may go into full-blown shorting mode. It would still take quite a bit more to have me go into a full-blown bullish mode right now. I just want to mention that. So again, to go back to what we're talking about here, we had let me change the tool here again. We had the 250-day exponential moving averages pinching recently. And they're still pinching. They're poised. I mean, one or two bad days they could cross over, but they haven't yet made that death cross. I'm sure a lot of people have been talking about recently. I've made mention of it, but we gapped above there today. So again, I wanted to talk about these double bottom, these swings of about 8% or so, with a bigger drop the first time around. That is of course, what we're looking at here. Keep in mind, where we're at right now. We had the earlier correction earlier in the year, and this is happening. Started in October, which is usually when you have big moves in the market. Very often they do happen in that last quarter there, around October. So, and just real quick before we move on, Nasdaq 100. Similar story, but again, you had the divergent low there so far, and you had the 250-day EMAs pinching, poised to make a bearish cross, but at the last minute, you see this big gap up, and looks like the bulls may have saved the day. I'm sure that's what a lot of people think, and maybe it proves to be the case. I am a very open and flexible trader, open to anything. I try very hard, to not fall victim to confirmation bias. So if I'm waffling, like I am now, I'm going to tell you that. And I'm also going to tell you that the way I treat that is step aside. You don't have to make a trade every day. In fact, the market is not an ATM that you can continually extract money from on a day-to-day basis as a trader. That I feel confident on. If there's somebody out there that is profitable every day, yeah, I'd love to hear about it. I'd love to hear your strategies. But this is when I make my money. I wait patiently for the objective setups, and if I have too many mixed signals, conflicting analysis, I'll just stand aside and let the charts develop, or wait for the next objective setup to come. So there it is. Now let's look at 2007. This is the S&P 500. Here's time scale here, so you can see back in 2007. Keep in mind the market back then, the top was in October of 2007. I need to change the color here on my tool. So here it is. There was a top right there. Here's October 2007. That is when the stock market topped. There's a top in the S&P 500 we're looking at here. And now, so the similarities I see, and I'll tell you one thing, I sort of hate finding these similarities. Every time I find a really good similarity on a stock or the market, and it's playing out very well, that's when it stops playing out. So take it for what it's worth. But again, there's more that goes into this here, and one of those again is seasonality. This is usually when, so far we've had a horrible October, one of the worst in years, and that is we've seen a lot of corrections come around that time. You remember Black Monday? That was back in 1987. That was in October. So here we go. So we had what I call a shot across the bow in, just like back then, early in the year. This one started in January this time around in 2018, but you can see back in 2007, we had a divergent high, negative divergence. We had a strong advance up to that, and then boom, a very sharp correction right there. Sharp drop. What happened? The markets powered on, they recovered, they went on to make a divergent high, just like they did this time later in the year, and just like this time around, that divergent high came in October, and so that's what's happened. Now, this one was a little bit different because you did have a remember, no two tops are going to be the same exactly, or no two anything in the market, any two periods of price action. But we're looking at patterns and similarities here. So you had this top in July, and then you had a correction. You had a spike. Remember that spike I just showed you on SPY, where we had a little candlestick wick there, or shadow, a tail, I should say. That was intraday move, and then that's where trading normalized right there. And then we came in, and just like we did recently, we put in a effectively a double bottom again, if you're just excluding that brief washout move intraday. So this looks a lot like the chart. We're looking at 2007 here, and this looks a lot like what we've seen recently. In fact, what I meant to do for you, so there's no distractions, is take this and just kind of color this out. Okay, because we didn't start the new year yet. So imagine this will be 2018. This is where we're at right now. So if you walk up to a shopping mall and they have the little the kiosk with the map and the little pin, you are here. Well, that is looks to me like where we're at right now. In other words, we've had this double bottom. We had at this point in time, you can see on these lines here, you had this is the 50-day exponential moving average. Here's the 200-day. For the first time in a while, they were poised to cross. See, they didn't cross here. They looked like they were going to cross, but they didn't. And this time around, we had the two lines converging. The 50 was heading down right on the 200, but guess what happened? A little pop up after that double bottom low, again, just like what we just saw in the markets now, popped up and snapped back above there. And I'm sure back then, is right now, there's a lot of bulls saying, wow, what a save. It looked like we were going to get that death cross. But the market's powered right above, smashed right through the 50 and 200 day like they weren't even there. We're going to new highs. So I'm sure there was a lot of that back then. But as you can see, that proved to be very fleeting. It's just the nature of the beast with this kind of volatility, these big price swings. So what happened is the S&P 500 fell back below both again, made one more attempt to get back above them, briefly did, and then boom, gave up the ghost right around the beginning of the year. So again, I'm doing this because seasonality is coming into play here. There's just a lot of similarities. There's a 2008 line back then, so that would be our 2018 line. So again, this may happen if this is where we're at. I might have done the UR here. Yeah, I did that wrong. This is where we're at right now, possibly because we gapped up or shot up pretty well above these, recovered these just as it looked like the crossover was going to happen. So watch for this. Now, you're not going to trade it exactly like this. Again, there's some similarities here, but if you're going to try to trade this pattern, and I also don't think we're going to see a meltdown scenario like 2008, but I do believe there's a good chance the top is in, and I'd like to watch and see what happens here. Maybe this time it's different. Maybe they hold. Maybe they hold above the 50 and 200 now and come back in, and it looks something more like this, where it looked like we were going to get a bearish cross, but there was more life left in the bull market at that point in time. So I'm open to all possibilities. I just wanted to mention those similarities, and let me also show you with the Nasdaq 100. 2017 top as well. I need to center that. And there we go. And so you can see similar price action back in early 2007, big sharp correction, just like we had in January of this year. And the market went on to push up to make another high. There was your divergence. And so far, again, the price action has been very similar. I pretty much walked through everything on the S&P 500 a minute ago. The lines on the Nasdaq 100 weren't as close here, but we did get that death cross shortly afterwards, after the new year started. Here's the 2008 new year. So again, everything was looking good. In fact, this one looks a little bit more like the S&P right here, where we had these double top highs so far. Since the correction started back, or since it started back in October of 2007, we had two kickback rallies to the same level on the Nasdaq 100, which was resistance. It was former support, and that's all she wrote. From there, it gave up the ghost. And then shortly afterwards, you had that death cross, the 50 down below the 200-day, and we all know, what happened from there. So let's wrap it up here. And again, let's just to go back to where we are right now. Let's just watch and see what happens. I just wanted to a few things I wanted to convey here, but one of those was that this recovery back above the 5200 day is not take it on face value for what it is, at least as long as we remain above there. You can call it bullish, but again, there's a lot of work to be done to the upside. However, if you see it fail again, or even if we continue to trade sideways, that's going to bring these lines down, and eventually you'll get across. Remember, they're moving averages. The 200-day is already flattened out. The 50-day is clearly, sloping lower, but right now they're pinching. So let's not put too much on the 15,200 right now at this point in time, but let's expect that they may get sliced through here in the coming days to weeks. And more importantly, if we get any type of, you know, bullish or bearish technical developments, I'll try to highlight that as I see them develop. And right now, again, something that I would be looking for would be a gap down, since we have this breakaway gap right here. If something happened tonight in the futures, and again, I'm not expecting any big moves, but you have to expect the unexpected in trading. So if we gap down tomorrow on both the S&P 500 and the Nasdaq 100 with a candle that looks like this, and we close the day below there, this would be what we call an island top. So one thing to watch for comes after an uptrend like that, and that could give us a sell signal, and it would put us back below these moving averages again, which would sort of negate today's bullish action. All right, we will wrap it up here. This is Randy Finney with Right Side of the Chart. Hope you have a great day.